Welcome back. You're watching Stock Watch with me, Thematic, and joining me to unpack your stock-related questions tonight are Jean Pierre Verster from Protea Capital Management and Zwelakhe Mnguni from Benguela Global Fund Managers. Be sure to send your questions via email to stockwatch@bdtv.co.za or via SMS on 41392 or on X @BusinessDayTV using the hashtag StockWatch. Thank you so much for your time, gents. It seems that there's sour sentiment in the markets today. Zwelakhe, I'm wondering if it has anything to do with the growth target that was set in China for 2024 of around 5%.
Znati, I think the growth targets actually, if it is achievable, I think it would be a good number. I think what is a bigger concern, certainly for me, is that China has been regarded as the factory of the world. And if the rest of the world was consuming, China should still be consuming raw materials, convert them into product, and then ship them out. And doesn't look like that is happening. That's the first thing. The second thing is that the consumer in China has become a lot more cautious. And it means that one of the drivers of the GDP is actually also just sputtering. So I think that maybe people are not believing that number as a start. But I think we also have our own issues here at home that are affecting us.
Yeah, quite interesting because, I mean, even last year they had that same growth target and they managed to surpass it, JP. And I'm wondering if markets don't think that that can be done again this year, particularly with this bazooka stimulus not coming through yet.
Well, yeah, data coming out of China is an interesting concept. You get the formal, the official data, and then sometimes people look at unofficial data to see if the official data is necessarily accurate. So for instance, you can look at electricity generation, or you can look at miles driven of cars that get tracked, and that sometimes tells you a different story to what the official data tells you. So if China tells you officially they are targeting 5%, I think you can be reasonably certain that their official data will show at least 5%. The question is whether the unofficial data will show 5%, which also means in the past year, maybe the economy didn't grow as strongly as what the official data shows. And remember, the best piece of data we have, Zenati, for any economy is the local stock exchange. And if you look at what China has got 3 stock exchanges. If you look at what Shenzhen, Shanghai, or Hong Kong has done, all 3 of those markets have been under significant pressure over the past year. So I'm also cautious on China, like Zwelakhe, and I am also cautious about the official data that they announce.
Yeah, quite interesting that you basically say that to look at how the economy is doing, you also need to look at the stock exchange. We have seen here locally the JSE really just seeming to bumble along and not getting all the record highs that we have seen in the US. And on that, there is a comment from a viewer. I agree with your guess. I don't know which guess. I don't know if it's you guys or other guess. Sad outlook for SA Inc. And repeat a question I asked last week, namely, I think what's happened to Pick n Pay recently is what will inevitably happen to other SA Inc. stocks. They are gradually declining and then will do so suddenly. Sadly, there has been too many headwinds battering SA Inc. for many years. I'm not sure if you can completely attach the economic woes in South Africa to the woes that Pick n Pay is currently experiencing. But Zwelakhe, let's actually start off with SA Inc. because the viewer seems rather pessimistic about the outlook for SA Inc.
Look, I think we've got some challenges as a country. I think we lack political leadership that can come up with reforms that can take the country to the next level. I think that's the first problem. I think the second problem is that our infrastructure is falling apart, and we are unable to derive the maximum value out of the economy during times of boom, and we essentially also creating a welfare state to some extent, where we are paying grants while the people who are paying tax are shrinking. And I don't think it's a bad thing to actually support to have social security, but I also think that the thinking doesn't evolve to how can we turn this social security into something that can basically create jobs. Why not maybe ask the youth to say sacrifice for 10 months and then you contribute your money into a project and you are a shareholder in a project. That's something that needs to be considered. But I think the biggest problem that we have is lack of political leadership. And I think the outlook is affected by the fact that when you go to this coming election, the ANC could lose power. They're going to be desperate to go into a coalition with somebody, and that somebody's going to dictate the terms. If it's the EFF, we know what's coming. They're going to go for the land issue. Again, if that land issue is handled in a disorderly manner, we're going to get into serious disaster in South Africa.
Yeah, really, listen, I understand the backdrop that these companies are operating under. But I mean, for example, now, in the second half of the year, we expect interest rates to go down, inflation also to come down. Does that not provide some cushioning for SA Inc. and maybe to not have such a pessimistic view of how SA Inc. is going to do, JP?
It's a very thin cushion.
Okay.
The problem we have is we have a very high real interest rate environment in South Africa. So our interest rates are relatively high. The cost of debt is relatively high relative to the growth in the economy. So the inflation can't really come down because the primary reason why our interest rates are where they are is to keep inflation under control. Because if you let inflation out of control, you've got a real problem. So thank goodness. We needed to choose between two difficult choices, and we chose to have high interest rates but keep inflation under control. But what that means is, in an economy that isn't growing, that's going sideways, if you are a company with too much debt on your balance sheet, and you are paying the type of rates on your debt that we have in this economy for the cost of debt, then you're going backwards and you're in trouble. So not all companies are in trouble. If you're a company with strong cash flows, a strong balance sheet, you do not have too much debt, you're okay. You're going to gain market share from your competitors. But if you're a company, like you mentioned, Pick n Pay, with too much debt, low growth, and costs that keep on increasing, you've got a real problem. So I'm also concerned about those types of companies that have got too much debt, because in our economy that's not growing, they're going to keep on losing, and the stronger companies are going to keep on winning. So you need to make sure you buy the winners and short the losers.
Well, okay, talking about Pick n Pay, talking about losers and winners, let's talk about ShopRite. They came out with results today and continuing to be the winner in that grocery retail sector. Zwelakhe, those numbers that came out of ShopRite, nothing to complain about?
Look, I think they executing their strategy very well, and it's bearing fruit for them. They're taking market share from their peers, and I think that online delivery thing has also challenged the likes of Spar in terms of displacing them in their own comfort zone. So certainly the likes of Pick n Pay that don't really have a strong value proposition. I mean, I don't know, as I sit here, what Pick n Pay stands for. And I think ShopRite has carved out a market where people go to them because they want lower prices, and they are also adding little features like your delivery. So I'm quite happy with the numbers from ShopRite.
All right. JP, even the volumes, are they what you would expect in this kind of environment where you can't really fault ShopRite for the reduction that we are seeing there?
Yes, like I mentioned, we're at the point in a very difficult economy where it's a relative game.
Yeah.
So even though the top line, you would wish for higher growth, you would wish for positive volumes, it's still better than the competitors. So that means they are winning market share, they're moving forward, cash flow is good, balance sheet is in a good position, and that's the best you can ask for in this economy. And companies like this, if everyone recognizes, like in the case of ShopRite, the shares aren't cheap. The shares are quite expensive. So there's a line of thought out there that says, don't buy ShopRite. Yes, it might be the best performing retailer, but it's also by far the most expensive retailer. Rather buy the shares of Pick n Pay or Spar. That is a turnaround story. The problem with that is that not all turnaround stories turn.
Yeah.
It only turns if you have a type of environment that's stable, that allows for the phenomenon of reversion to the mean to play out. And if you don't have a stable environment, if you have a tough environment, then things don't revert to the mean. Winners keep on winning and losers keep on losing.
Yeah, a very strong pillar of investing that we need to keep in mind, that just because the share is cheap doesn't mean go and buy it, yeah, as you hope for a turnaround. Let's go to hospitality. There's a question on Sun International. Can you ask the panel their view on Sun International since they bought Piedmont? Of course, that's the owner of Emperor's Palace. Is the share going places? Zwelakhe?
Yeah, I don't know about the share going places, but look, I think there's a bit of consolidation that was needed in the industry. I do think that Sun International's capacity utilization on the hotel side is close to full. So they probably needed avenues to find more growth on the gambling side. So certainly, from the numbers that they reported, I mean, it's been a decent business. I don't think one could fault them by much, but certainly it's the consolidation is needed, in my view.
All right, I hear you on that. Second part of that question, would you buy more at current levels? And can this share reach 56 Rand per share next year? At this point, it's at around 39. JP?
Next year is a bit soon for me, Zanate. My crystal ball is very cloudy. So what I can tell you is if they keep on executing, the group will do well and the share price will follow. And the execution I'm referring to is that in the purchase of Piedmont, the big asset they were looking to get is Emperor's Palace. It's a very cash generative casino complex with hotels on the premises as well. And on its own, Piedmont was over indebted. It also had too much debt. Yeah. That seems to be a theme going on at the moment. And by combining it with the Sun International balance sheet, that is a very strong balance sheet. They've de-geared after they exited South America and raised some capital a few years ago. It means that they could make this acquisition, pay a reasonable price, but sort out the debt issues that Piedmont could not sort out on their own because Sun International had a strong balance sheet. So yes, if Sun International executes well, and our gambling activity stays reasonably strong. There's also an issue going on between physical gambling, casinos, versus online gambling. We see a lot more people doing sports betting and gambling on their phones, which is not good for the land-based casinos. But as long as that doesn't get too hectic for the likes of Emperor's Palace. And Sun International have hedged their bets with SunBets, with an online betting platform as well, then I think Sun International shares could do well over the long term, not just in the coming year.
JP, I've been waiting for you to join me on the Stock Watch DX because there's been a question that's been waiting for you for about a week. What themed ETFs would you currently be long and short?
Okay, so I'm a stock picker primarily. I don't look at themes, but if I look at the stocks that we pick, sometimes a theme appears because there are very similar stocks that all look attractive to us. And at the moment, for a while already, but still, I quite like the European banking sector. Not the US banking sector, just the European banking sector. So I wouldn't mind being long a European banking ETF, to use an example. And on the short side, it might be a little bit early, but I'm getting ready to look at a themed ETF that looks at artificial intelligence. I think it could be the new ESG. Which is not a compliment. What I mean by that is a lot of money could flow into the theme because everyone thinks AI is the next hot thing. And a lot of companies that actually just say they do AI while they actually don't will get a lot of money. Their share prices will rise. There'll be a lot of interest in their shares from retail investors, and that could create a bubble. So I'm getting ready to potentially short an AI ETF, but I'm not quite there yet. I still want to give the bubble a little bit more time to get a bit bigger before potentially it pops.
Well, talking about themes, there's now the granolas. As you're talking about Europe, of course, we know the FANGs and we know the Magnificent Seven that has taken investor attention, but now granolas seem to also be taking over. Zwelakhe, is this a theme that you're looking into?
No, like JP, I mean, I don't look at themes. I try and look at companies in their raw fundamental data, and I really don't subscribe to themes.
JP, would you be looking at the granolas?
So I think whenever a company forms part of these acronyms, you must know that it's a hot area. So at the moment, yes, some large European stocks are hot. Some of them might be expensive, some of them not so much. Like for instance, I still like LVMH. I think that's a company that's not too expensive. While ASML, the the Dutch company that's involved in semiconductor equipment, I think that has got quite a bit more expensive than what it needs to be on the back of NVIDIA and the whole AI boom. So maybe a few letters in granola look decent, a few other letters look a bit expensive, and that's why I like to pick my letters rather than eating the whole granola bar.
Love that. There's a question here on listed alternative asset managers, Apollo, KKR, Blackstone. So, Zwelakhe, do you have a view on those, the listed alternative asset managers, Apollo or KKR or Blackstone?
Yeah, look, I don't look at those companies directly because, I mean, they partly are competitors to some extent. So we prefer to build portfolios directly. But I think the one thing I'd say in the alternatives market that we are seeing is that as we get more and more volatility in this listed space, the unlisted space may offer investors a bit of stability in terms of the valuation, but also because interest rates are high, there may be a benefit of a higher premiums that these guys are extracting in the alternatives market. So I am not in that asset management space, but definitely do think that they would probably be doing very well financially because they charge so much fees, more than JP.
JP, do you look at these listed alternative asset managers?
I have looked at them, not all three in a lot of detail. And yes, the fees are eye-watering. Normally it's 2 and 20, a 2% fee per year, plus 20% performance fee. And quite often the 20% performance fee doesn't even have a hurdle. Now, Zwelakhe made a joke, but I must say, we have hurdles and we only charge 1% per year. So it's difficult for us to earn a performance fee. For these alternative managers you mentioned, they earn performance fees almost every year. So yeah, sometimes you wonder if they really performed and earned those performance fees. Of the three, the one I've looked at in a bit more detail is Blackstone. And because of the strong fees, it does look reasonably priced. I don't know the other two as well.
All right. Well, let's get into some of the company news that we had out of the JSE Netbank. We had Mike Brown doing his last rodeo, his last results interviews as he is retiring in May, leaving the bank in quite a sweet spot there as we saw double-digit growth from the top line to the bottom line. Zwelakhe, those numbers as expected?
Yeah, look, the numbers were decent. I think you could almost say Mike Brown had to ensure that the business gets away from the commercial property market exposure before he actually gets out. So it was good to see that they're seeing some improvements in that area. But broadly speaking, the numbers were decent. I mean, I thought it's a good time to be handing over. He's also sealing his legacy that I left a good bank. If anything happens to it, that was your problem.
Yeah, indeed. And we actually did even see that share price. I think it was up over 3-4% at some point. JP, do you think that Netbank is one of the banks that stands to have maybe more upside than the other banks at this rate?
Well, interesting enough, it's one of the cheapest banks on a price-to-book basis, and they increased their ROE target. So that by itself is positive, and the ROE target, I think, is now 18%. It's quite a bit higher than the cost of equity, while Netbank is trading, call it, around book value. So in itself, that implies that if they can hit their targets, you can justify a nice premium to book value. So yes, if you compare the four universal banks, I think ABSA might be slightly cheaper than Netbank on a price to book ratio. So Netbank would be second cheapest, but at the ROE, if they can maintain an ROE of 18%, then there could be decent upside from the current levels, yes.
Yeah, all right. Well, a company that seems to be trading on the downside lately, because we even saw with their trading update, investors not really liking that much, is Curro. They also came out with results today. And Zwelakhe, I'm still surprised that investors are still dumping the stock, even though I think the numbers were well guided.
Yeah, I think from my perspective, there's two issues. I mean, I think the student numbers growth was not exciting at all. So I think that's something. I think they've been bailed out by inflation. I think the second thing is also that their capacity utilization on the schools that they built is still fairly low, and they need to do a lot of work to actually increase their capacity utilization. But I think on the positive side, I mean, they've turned free cash flow positive, which is something that is probably worth celebrating. I mean, they've been sucking cash for years. So yeah, I think it's positive. But I do think that if one is patient, it could be a stock to hold. But if you think in short term, and there could be twists and turns with the economy that could suppress their school student numbers. Particularly, we also noticed that the debtors numbers are growing. So parents who are unable to pay them are actually also falling behind. It's something that is a bit of a concern.
JP, yeah, I mean, just considering also that Curro is also benefiting from the failures of the public system, this pressure that we have seen recently, would this maybe provide a good opportunity for some investors to plow into the stock?
Yes, I think the private education sector has got tailwinds because, unfortunately, how bad the public sector schooling has become and the pressure it is under. You know, one must also not think that Curro is this exclusive school, extremely expensive. There's a lot of middle income people who would rather not go and eat out every weekend, but send their kids to a Curro school and get good schooling. So it's not just the elite. That's a misconception.
Yeah.
And I do think that puts Curro and Advitech as two good opportunities over the long term because of the values of the state, yes.
All right. Well, let's get to your stock picks for today, gents. Zwelakhe, what are you picking for today?
Oh, I thought you were starting JP. Okay, I'm going with Goldfields. I think I'm a little uneasy about what's happening in Eastern Europe at the moment. And I think we are seeing NATO bringing more and more assets closer to Russia. There is a risk that there could be a misunderstanding or a mistake, and that could trigger something even bigger. So my concern is that I need to try and hedge some downside risk, and basically using Goldfields as a stock for that.
All right. And on your side, JP, what will it be?
I'm also cautious, so I'm looking at the local market for things that aren't too expensive. They might not be exciting, but they're solid. And Life Healthcare, I would say, ticks the box. They are going to pay a R6 special dividend, and the share price is called roughly 17.50 Rand. So that means that excluding the special dividend you'll get in roughly 2 months, it's trading at 11.50 Rand. And I think the fair value is closer to 13 Rand at least. Yes, it's not an exciting sector, but it's solid. People will still get sick and need to go to hospital, notwithstanding NHI. That's the big risk that could happen at some point, although it looks like the chance of that is also getting lower. So that's my stock pick, Life Healthcare.
All right. Well, thank you so much for your time and for your analysis today, gents. Much appreciated. That is all for tonight's Stock Watch. Thanks to our guest, Jean Pierre Verster from Protea Capital Management and Zwelakhe Mnguni from Benguela Global Fund Managers. Up next, The Close. Stay watching.